This is Jody Trana with Chapter 9, Part 1 of Principles of Accounting. When we sell merchandise or services on account, it creates an account receivable. As a business, we need to keep track of all of our accounts receivable, and that's why we've started using the Accounts Receivable Subsidiary Ledger. It tells us who owes us money. We also have to consider the fact that not every customer will pay us even though they owe us. We're going to start using a new account called the Allowance for Bad Debts. The Allowance for Bad Debts is a contra asset account that shows up as an adjustment to accounts receivable. As you can see here, the accounts receivable amount is reduced by our allowance for doubtful accounts. These two amounts netted together is called net accounts receivable, and it is our net realizable value. It's what we believe we really can collect on our accounts receivable. Unfortunately, we don't always get the cash for our accounts receivable balances. There's two terms that we use for accounts. One is doubtful. A doubtful account is something that we predict is going to be uncollectible, but we still don't know quite yet. A bad debt is an accounts receivable that we have officially written off, or one that we need to because we know it is uncollectible. As accountants, we want to make sure that all of our balances reflect good numbers. That means in our accounts receivable, we want that number to reflect what we actually do intend to receive. That means from time to time, we need to write off amounts that are uncollectible. There's two general ways to do this. One is called the direct write-off method. And with the direct write-off method, we are assuming that when we know absolutely that an amount will not be received, we write off that specific amount. The direct write-off method is not approved by GAAP when we're talking about material numbers. GAAP prefers that we match our revenue and our expenses, and they also want to know that our accounts receivable balance at any particular time reflects a good receivable balance. The other method is an allowance method. What the allowance method does is it takes portions, maybe percentages, of your receivables that you think are generally uncollectible based on your past experience, and it sets up an allowance account, assuming that that amount will probably not be collectible. GAAP does approve of this and gives us a little bit more accurate view of our accounts receivable from month to month. Let's take a look at a journal entry for a direct write-off method. Let's say that Gate City Cycles has trouble collecting from Sherry Silverthorne. On June 19, Gate City decides to write off this $700 account receivable. The entry would be to immediately expense the $700 to bad debts expense and to credit the accounts receivable for Sherry Silverthorne. This writes off the amount for her, and it may seem fairly generous, but it's extremely unlikely that we would ever do business with Sherry Silverthorne again. Sometimes when we as a business take a strong stand, and in this case let Silverthorne know that we would not be doing business with her again, sometimes that spurs on a payment. Not always, but in this case we're going to say that on December 31, Silverthorne actually sent a check to Gate City Cycles. Now we had already written that amount off. So the first thing that we have to do is to reverse that write-off. So we're going to reestablish the accounts receivable by debiting it for $700, and we're going to credit bad debt expense. We don't usually credit an expense, but all we're doing is reversing that original write-off that we just did. Then we're going to record the cash received and put that against her accounts receivable of $700. In this course, we're going to use two allowance methods. Both of them rely heavily on the accounts receivable balance. The first is the percentage of receivable method, and the second is the aging of accounts receivable method. Both of these methods are used to determine the new balance in the allowance for bad debts account. You can see here that I have the balance in the allowance for bad debts account in green. This is the amount that both of these methods will calculate. Let's take a look back on how this allowance for bad debts looks on the balance sheet. You can see here that it's called allowance for doubtful accounts, but it is the same thing. What we're trying to calculate is a balance to offset our accounts receivable amount. This allowance is going to reduce our accounts receivable by amount that we believe is uncollectible. Before we dig into either one of these methods for calculating the allowance for bad debts, let's look at a big overview of how the allowance method works. We're going to look at a company called Winter Retreats and the journal entries that would be posted to record a full year's worth of activity. The first transaction is for sales revenue on account of $292,100. We're going to ignore the cost of goods sold journal entry that would normally also be posted with this. So we have accounts receivable debit and a sales revenue credit. The second entry is collections that we have made on these accounts receivables. All of our collections go into cash, so we have a cash debit of $217,000 and an accounts receivable credit of the same amount to reduce our accounts receivable balance since we've made these collections. The next journal entry is for write-offs. Throughout the year, Winter Retreats has decided that specific accounts are not going to be collected and have written off these amounts. We write these off by taking money out of accounts receivable and putting it into allowance for bad debts. Keep in mind that on our balance sheet, it won't look any different because we're just moving it from one account to another account. But it does at least reduce our accounts receivable balance itself to show that less money is going to be collected. The second adjustment here is for when we have an estimation, and this would be an adjusting journal entry to establish our bad debts expense for the period. This is usually based on one of the methods that we talked about, and here they have calculated that to get to the balance that they want, they need to adjust the allowance for bad debts account by $5,400, and the expense is bad debts expense. When using either one of these allowance methods, the only time that we expense bad debts is when we do this adjusting journal entry. You'll notice that the journal entry that's above this one is when we wrote off specific accounts that we knew were uncollectible. When we did that, we did not expense them. We just moved them out of our accounts receivable and into our allowance for bad debts. Then our allowance for bad debts account gets adjusted when we do these adjusting journal entries each period. Let's do the T accounts for each one of these journal entries that we just did. We're going to say that our accounts receivable account has a beginning balance of $10,800 and our allowance for bad debts account has a beginning balance of $6,600. The first transaction to post is our net credit sales. You'll see here we're posting our debit to accounts receivable. Our credit would go into our sales revenue account, which we're not looking at here. Next, we'll report our credit to accounts receivable for the cash collections we have taken in. Next, we have the journal entry for the $6,200 that we believe to be uncollectible. We've moved that amount out of our accounts receivable by crediting accounts receivable and moved it into our allowance for bad debts by debiting that account. And finally, we're going to record our bad debts expense of $5,400, which also puts a credit into our allowance for bad debts of $5,400. Here you can see our balances in these three accounts. The main one I want to point out is the allowance for bad debts. We were told that when they were calculating their new target balance in allowance for bad debts, they had identified $5,800 should be the new balance in the allowance for bad debts account. So you can see with our adjustment here, our adjusting journal entry of $5,400 as a credit, we have determined that our ending balance in allowance for bad debts is the amount that they wanted of $5,800. Now we're going to look more specifically at the two methods to calculate our allowance for bad debts. The whole purpose with both of these different methods is to identify a new balance in allowance for bad debts. So the $5,800. Each one of these methods is going to give us a new balance for bad debts based on historical or industry information. The first problem that we have is with Wedge Company. Their accounts receivable balance last year was $21,000. During the year, Wedge earned revenue of $462,000 and collected on account $331,000. They also wrote off $5,500 worth of receivables as uncollectible into their allowance for uncollectible accounts. This leaves an unadjusted ending balance of $146,500. This right now is the accounts receivable balance. For Wedge Company, we're given the information that industry norms suggest uncollectible accounts in the amount of 3% of the accounts receivable. Remember that the accounts receivable balance we just calculated is $146,500. So with this information, consider what the new balance should be in the allowance for bad debts account. We're going to take that accounts receivable balance of $146,500 and multiply it times the 3% industry norm to get our new balance in allowance for bad debts of $4,395. This won't be our journal entry. This is our desired ending balance. So we have to figure out what our balance is in the account first in order to know what our adjustment should be. With Wedge Company, we're told that the most recent unadjusted balance in the allowance for bad debts account is $2,400 credit. Remember that we want our balance in this account to be $4,395. So that means we're going to need to do a journal entry for $1,995 credit in order to get this to balance. Our debit is going to be bad debts expense. Now let's just say that we have instead a debit balance in our allowance for bad debts account of $1,400. We still want that ending balance of $4,395. So in this case, we're going to have to credit our allowance for bad debt accounts in the amount of $5,795. That would be $1,400 plus $4,395. When we're starting out with a debit amount, we have to credit it for $1,400 first and credit it for $4,395 to get to a $4,395 credit balance. The final allowance method, and probably the most realistic, is the aging of accounts receivable method. We're going to look here at the Sign-Off Lamp Company. Assuming that they have a balance in accounts receivable right now of a debit, $73,000, They also have a balance in allowance for bad debts right now of $1,058 credit. Here's what an aging of accounts receivable information or report looks like. This shows us how old our accounts receivables are and what the percentage of collectible are for each age of accounts receivable. So when our accounts receivable are 0 to 60 days old, we have a 3% amount historically that we do not collect. So in this balance, this 0 to 60 days, we have accounts receivable of $71,000. Since we don't usually collect about 3% of our 0 to 60 day accounts receivables, we are counting on not being able to collect $2,130 of this age. The next age that we look at is over 60 days. As we would expect, as accounts receivable balances get older, we have a greater chance of those balances being uncollected. For our over 60-day accounts receivable, we estimate that 20% will not be collected. That is $400 based off of our $2,000 accounts receivable balances that are over 60 days. Many companies will do more categories than just the two here, but this gives us an idea of what an aged accounts receivable looks like. So of the $73,000 that are in our receivables, we expect to not collect $2,530 in total. Again, we're going to need to figure out what our adjustment is. Remember, our allowance for bad debts right now is $1,058. What we've determined is that we want our allowance for bad debts to be $2,530. So we need to make an adjustment to get it to that balance. Here we can see a T account with our beginning balance of $1,058 and our ending balance, which is our desired ending balance of $2,530 credit. We're going to need an additional credit of $1,472 in our allowance for bad debts account in order to get to our balance that we expect to have. So we will debit our bad debts expense for $1,472 and credit our allowance for bad debts of $1,472.